This week we're going to look at a request that came through, which was to have some understanding of a candlestick pattern which is called a doji. Many years ago, well not that long ago now actually, I did a whole series of comprehensive tests on candlestick patterns, and the results that came out was that unless you had quite a lot of other analysis to connect with them, then they were largely random in nature. One major difference was dojis. When you think about it, candlesticks actually have a pattern for absolutely everything, which suggests that along with some other parts of technical analysis, there's a solution for everything and an answer for nothing. Dojis were very much different, and you can connect them with relatively basic analysis to create turning points or points of reference where you really need to be involved. Dojis are the only candlestick pattern that I use with any regularity, although I do look at candlestick charts, and the reason I do that is because it's easier to see the relationship between the open, the close, the high and the low. So what are dojis? The pattern is basically when the open and the close are identical in value or very close. The original premise was that this indicates uncertainty in the market as a tug of war occurs between bulls and bears. They are traditionally also regarded as reversal patterns, but as far as I'm concerned, in the testing that I've done, they have equal power as both reversals and continuation patterns. What we have here is, because they're so commonly known, when the doji fails to be a reversal, we get people being forced out of the market who were trying to pick a top or a bottom. If they occur within a sideways or in low range, it indicates that the market is either in balance and contented. There are a couple of times where that's not true, when the range is very low. Dojis take many forms, but ultimately always act as a warning sign. What I mean by many forms is the fact that we have lots of different types of dojis. Long-legged dojis, where you have a wide range; shooting star dojis, which are normally an uptrend; hanging man dojis; gravestone dojis; tri-star dojis; evening doji stars; morning doji stars. So there's a variety of names. However, they're just always a reference point. The longer the time frame, the more significant dojis tend to be, and have more power than many patterns when applied to very short time frames, especially when linked to volume. So when a market gets a little bit crazy or it's trending very strongly, come down to quite a low time frame chart, 15-minute definitely on FX, you can even go as low as 5, and you can connect dojis there. Here I've just taken, as it turns out, it's quite an old slide of the S&P daily, and I'm just highlighting where some dojis occurred on this chart. What we have here is one that was caused by a rollover in the futures, which occurred here. That was what would really be called a long-legged doji, because the range is there. This one is really a perfect long-legged doji in that it has the open and the close pretty much in the middle of the range. Over here we have a shooting star doji, so the open and the close are towards the low of the range, and we've been moving upwards. And then we have ones occurring here before finally the market starts going up. Now, because dojis are a candlestick pattern, they are exclusively used in Japan. Every time I go to Japan, just about, well, every single trader has a candlestick chart. Nearly everyone has Ichimoku on there, and everyone looks at dojis and patterns. And so dojis traditionally have more power on Japanese markets, so if you're trading the yen, you always want to be aware of when they're occurring. And in this, there's a couple of classic examples. Here we have a tri-star doji, so 3 dojis in a row, more dojis down here, and we have a bit of a cliche: never sell a quiet market. This was a time where the Bank of Japan was consistently intervening in the dollar yen, and so what would happen was we'd get these short covering spikes that occurred, and eventually we had such a low range that nobody was actually involved, and then the market then exploded higher. Dojis can quite often give us clues within a sideways pattern after a trend, and so here what we have is dollar Canada, and there's a few dojis within that sideways pattern before finally the market does break out. Initially, a shooting star doji caps the move, and then once we close above the high of that pattern, that's confirming that the trend is restarting. Here we just have an example of where dojis can really do two separate things. Unusually, both of these patterns have 3 dojis in a row. You could have argued on the right hand side dojis that it was forming a head and shoulders pattern. For some people, they might say that this very big down day said that the trend had changed. The reality is that we're simply interested in the confirmation of the doji, whether it's a reversal or a continuation. And in this instance especially, the market then exploded back up once it moved into what I call a vacuum from this day here. Here's an example after a long-standing uptrend that people start getting involved. The stochastic probably would have crossed down, encouraging top pickers, and then the price suddenly reverses very sharply, makes new closing highs, and creates a bit of a short covering binge. We can connect dojis to trend lines, a very good way of doing it. There are specific rules about how I do trend lines, which I'll do in another video. This is the Aussie dollar, and we have a channel, classic channel, and this is, and then we can see that down the bottom here, when it hit the lows of that trend line, then we had a doji. The next slide just shows that a little bit clearer. So price goes to the line perfectly. It then has a doji, a long-legged doji. Price then comes back towards that trend line again the following day before finally we get confirmation and the uptrend starts. With any pattern, it's always very important that you have some sort of confirmation associated with it. And here, it's not a stock market, it doesn't really matter what it is, but it was a very strong trend. And there was a series of dojis that failed before finally we got one up here. And there's 2 ways that we can look for confirmation. The first thing would be the breaking of supports and resistances, which is not necessarily visible on a candlestick chart. But here what I've done is I've put a moving linear regression line on the chart, and what we're interested in is when the moving linear regression changes direction. We're not worried about whether price closes below or above it. Moving linear regression is the best way to track a trend, in that it will track that trend however steep or shallow it happens to be. So what you have is sensitivity without lag. Just highlighting how an indicator such as the stochastics can cause you a lot of problems in a trend. We have consistent divergence there, so price is making new highs, stochastic is trending downwards, and that is can be used to try and confirm dojis. Well, I would say that's a pretty dangerous way to go. You really want something a little bit more sophisticated to understand that. Now we've just looked at, this is an intraday chart, and one of the connections is the fact that we can have volume with dojis. And here the market comes down, we have a rejection of value, and the volume is very high in terms of both ticks and actual volume. So if I get a doji with volume, that's telling me on a very short-term basis that the trend is exhausting itself. Here we have an example of a doji that is not at the absolute low. Volume is relatively high as well, but it acts as a continuation. Price closes below that doji and the trend then restarts. So we're just going to have a quick look at a couple of examples in the Eurodollars where we are now. First thing on this Eurodollar chart, this is weekly, and as we've approached the lows, and remember from last week this is just ahead of a 0.618 retracement, we've actually had 4 dojis in a row. So far that pattern really hasn't fulfilled itself. It's a warning sign, but as far as I'm concerned, we've got to close above 138.40 or make new closing lows, and that's going to dictate what the next trend is. Just an example of volume. Here I have, I'm just going to scroll across here, have 2 dojis here and here, but actually there's a wild difference between the two. The second one has much more volume associated with it, and as far as I'm concerned it was more of a downtrend, and on my volatility time bands I've hit the second deviation of limit of range for the time of day.